Welcome to the Deep Dive. Today we're jumping straight into Ford's Q3 2025 results, the key numbers, and maybe more importantly, why their outlook for the year changed so much.
Exactly. It's quite a story. You've got solid core performance, but then these massive external hits. Our job is to figure out what's really going on under the hood, so to speak.
Okay, let's start right at the top. Q3 2025. Total revenue, a record $50.5 billion.
Yeah, up 9% year over year. Looks great on the surface.
But then, adjusted EBIT, that core profit number, is $2.6 billion, flat compared to last year.
Right, and that flatness is, well, it's a bit misleading, isn't it? Because baked into that $2.6 billion is a pretty hefty tariff impact, around $700 million.
$700 million just from tariffs. So not really about how well they sold cars.
Not directly, no. It's more geopolitical, logistical stuff hitting the bottom line. If you actually pull that $700 million out, then adjusted EBIT would have improved year over year by about $700 million. So the underlying operations actually showing strength.
That's a critical difference for you, the listener, to grasp. It's not operational weakness, it's external pressure. And financially, they seem pretty solid despite this. Liquidity.
Oh, very solid. They're sitting on nearly $33 billion in cash. Total liquidity is around $54 billion. You need that kind of buffer when things like fires happen. We'll get to that.
Right. And cash flow.
Strong, too. Adjusted free cash flow hit $4.3 billion in the quarter. That's up $1.1 billion from last year. That cash generation is vital right now, gives them breathing room. They even declared the regular dividend, 17 cents.
Okay, so the overall picture has these layers. Let's peel them back with the Ford Plus segments. Ford Pro, Ford Blue, Model E. Where's the real profit engine?
Well, it's not exactly hidden. It's Ford Pro, commercial vehicles. This is what they've been building as their durable profit source, and it's delivering.
The numbers look pretty impressive. Q3 EBIT for Pro was $2.0 billion.
Yep, $2.0 billion, up $172 million. And the margin, 11.4%, very healthy.
And revenue was $17.4 billion, up 11%. But you mentioned something interesting about volume.
Right. Volume only grew 9%. So revenue is growing faster than the number of vehicles sold.
Meaning they're making more money per vehicle or adding services.
Exactly the latter. Services and software. That's the key. Paid software subscriptions.
Yeah.
Up 8% just in the quarter. They have over 800,000 subscribers now.
Wow. So telematics, fleet management, that kind of thing.
Uh-huh. High margin, recurring revenue built on the back of transit vans and Super Duty trucks people need. Very strong segment.
Okay, let's shift to Ford Blue, the traditional gas and hybrid side, the bedrock.
Yeah, Ford Blue is, stable, profitable, $1.5 billion in EBIT, margins 5.5%, revenue grew 7%, which shows there's still a lot of strength in that core portfolio.
Like the F-Series truck, it's still dominant.
Absolutely. On track for, 49 years as the best-selling truck? It's just phenomenal.
And things like the Bronco.
Bronco had a record quarter, over 30% share in its segment. So yeah, EBIT was down just a tiny bit year over year, about $84 million. But fundamentally, Ford Blue is solid, still pulling its weight.
Which brings us to Model E, electric vehicles. This is where things get volatile.
Volatile is a good word. Look, Model E is deep in the investment phase, and the whole EV market is facing headwinds, especially pricing pressure. They reported a Q3 EBIT loss of $1.4 billion.
Okay, hold on. A $1.4 billion loss, that's actually a bigger loss in dollar terms than Q3 last year, right?
Yeah.
Which was $1.2 billion?
It is, yes. The dollar loss is bigger by about $179 million.
So how is that progress? I mean, for the listener, a bigger loss sounds bad.
It's a fair question. It sounds counterintuitive, I know. But you have to look at the margin and the scale. They're spending a ton right now. R&D, new factories, launching vehicles. That increases the total spend.
Okay.
But the EBIT margin, while still deeply negative at negative 79.1%.
It sounds terrible.
It does. But it's actually better than last year. It improved by almost 26 percentage points.
Ah, okay. So the massive fixed costs are being spread over more vehicles. Each car sold is losing less money towards covering those big investments.
You got it. That's the scaling effect. It's a sign, hopefully, of moving the right direction, even if the total dollar loss is higher temporarily. And the volume backs that up. Revenue was up 52% to $1.8 billion. Wholesales jumped 57%. A lot of that driven by new products in Europe.
But still facing headwinds like pricing, tariffs, and plant changeover costs.
Oh, yeah. Those are huge drags. But the underlying mechanics are starting to show signs of life, signs of future scale.
Got it. Okay. That complexity leads us straight into the big news. The revised guidance for the whole year. The original forecast was adjusted EBIT between $7.0 and $8.5 billion. The the new one.
Much lower. It's now $6.0 billion to $6.5 billion for the full year 2025.
So at least $500 million chopped off the bottom, potentially $2 billion off the top. That's huge.
It is. And look at adjusted free cash flow, too.
Right. That went from $4.5 billion down to just $3.0 billion. Something really significant must have happened. Something beyond just EV pricing pressure.
Bingo. One single major event is the primary cause here, the Novelis fire.
A supplier fire. How much did that one incident cost them in expected profit?
The estimate is staggering. An adjusted EBIT headwind of $1.5 billion to $2 billion just from that fire.
$1.5 to $2 billion. That basically explains the entire guidance cut right there.
Pretty much. It disrupted the supply of essential aluminum sheeting, mainly for the F-Series trucks. It essentially wiped out a huge chunk of their expected profit for the year.
Okay, but explain the cash flow impact again. The profit hit is $2.0 billion, but the free cash flow hit is even bigger, $3.0 billion. Why the difference?
Yeah, that's working capital dynamics. Think about it this way. The fire stops production or slows it way down, but Ford still has costs. They're still buying other parts, paying workers. Cash is going out.
But the finished trucks aren't going out the door to bring cash in.
Exactly. You're spending money building incomplete vehicles. That ties up a massive amount of cash in the short term. That's the negative working capital impact. So the cash flow hit looks bigger this year.
But it's temporary.
Should be largely temporary, yes. Once they get the aluminum supply back and finish those trucks, they'll sell them. That cash should flow back in during 2026. They expect to recover that $2-3 billion in cash then.
Okay, so less of a permanent loss, more of a cash flow traffic jam caused by the fire. Now let's put it all together. Strip out the Novelis fire impact and the tariff impact you mentioned earlier. What does the core business look like?
Well, this is the fascinating part. They're absorbing the Novelis hit, and they now expect about a $1.0 billion net tariff headwind for the whole year. Even with both of those massive external drags, the underlying business, based on their own execution, was actually tracking towards the higher end of that original $8.5 billion guidance range.
Seriously. So Ford Pro, Ford Blue, cost control, all that was working really well.
Extremely well, it seems. It shows the strength in the core plan. But, you can't always control external shocks like fires or tariffs. Those just overwhelmed the strong operational performance this year.
Are they doing anything to fight back against the Novelis impact?
They are. They're working hard on mitigation. They think they can claw back at least $1 billion of that EBIT hit next year in 2026. And importantly, demand for trucks is still strong, so they're actually hiring up to 1,000 people to boost F-Series production capacity, trying to make up for lost time.
So the key takeaway here seems to be this tension. Strong execution internally, but just getting hammered by external volatility.
That's exactly it. I mean, look, this was their 5th straight quarter cutting costs year over year if you exclude tariffs. That shows discipline. Ford Pro and Ford Blue show the Ford Plus plan has legs. But these external events, they just dominate the 2025 story and force this painful guidance reset.
A really clear picture, despite the complexity. Thanks for walking us through that. That wraps up our deep dive into Ford's Q3 and revised outlook. Thanks for joining us.
My pleasure. And maybe a final thought for you to chew on based on all this.
Super
Given how one fire at one supplier, Novelis, could impact Ford's profit and especially its free cash flow so drastically, what does that really tell you about the fragility that might still exist in these huge, complex global supply chains? Even for a giant company that seems to be managing costs well, how much can you truly de-risk when you rely on single sources for critical parts? Something to think about.